Hello everyone, good afternoon. This is Abdel Ambarki. First of all, thanks a lot for joining us. It's our 5th session of our Basel IV channel. I'm so glad that you are all joining us. I think the popularity of our channel is significantly increasing. We're getting some good feedback and we are just developing on some feedback we get from you guys. So excited here. Just for some of you who are joining for the first time, because of course we've been doing this now for the 5th time, so we've explained basically what the Basel IV channel is, but for those that are joining the first time, I'll just quickly say what the Basel IV channel is, and then I'll go to introduce my co-speakers before we go further to the agenda and the topic of today. So basically when we started our Basel IV initiative, we thought about the best way to share with you, with our clients, all the developments that are coming from the Basel Committee, which we phrase as Basel IV. And in doing that and thinking about it, we thought about, of course, sending a newsletter, all types of other media, but we thought doing a quick, say, 20, 30 minutes monthly channel or WebEx to give you the latest update would be most efficient. And we got quite some good feedback, which proves that this is a good way to interact with you. So before we head further, I would like to give you the topic of today. As you know, it's the constraint on the use of internal models. Our previous topics have been, the first one was the general introduction to Basel IV and what we understand in our view, say, is Basel IV, because as you know, still regulators and supervisors don't want to call this Basel IV. The basically tsunami on a new proposal from the Basel Committee, but we explained to you what we think can be phrased as Basel IV given its significance. So the second episode was about the proposals on the new standardized approach for credit risk. And then the third and the fourth, we covered basically the fundamental review of the trading book, or basically fundamental review of the market risk framework. And today we are covering the constraint on the use of internal models. Before going to the agenda, I would like to hand quickly over to my co-speakers to introduce themselves. As you know, my name is Abdel Ambarki. I'm from the Netherlands. And I'm the deputy to Martin Nijs, who is leading our Global Basel IV initiative. And I'm responsible in the Netherlands for our Basel IV initiative. I would like to ask my colleague Luis to give a quick introduction of himself.
Yes, sure. Thank you, Abdella. My name is Luis Felipe Barbosa. I'm a director of the Financial Services Risk and Regulation Department in PwC, Portugal. And I have the pleasure of being currently leading the PwC European Initiative on internal modeling, including in particular the assessment of Basel IV impacts on credit risk models.
Thank you, Luis. Stefan?
Hello, everyone. My name is Stefan. I'm a senior manager in the Regulatory Management Division of PwC Germany.
Thank you, guys. I'm very pleased to have you guys here. Stefan, a specialist in Basel IV, and indeed Luis leading our internal models part of Basel IV. So what we'll be covering today? The agenda for today is, first of all, I would like to give you an overview of the IRB development, because I said before all the changes from the Basel Committee, but on the IRB model side, we have to admit that it's not only changes coming from Basel, or at least the focus is not only from Basel, from the Basel Committee, but also coming from Frankfurt, from the ECB, as well as from London, from the European Banking Authority. So the second topic we'll discuss basically the EBA's view on the future of the IRB approach. And then after that we will discuss basically what is covered under Basel IV and the paper that was published by the Basel Committee by the end of March this year, basically introducing constraints to the use of internal models, including limit and estimation practices and setting certain parameter floors. Then we'll go to the currently ongoing targeted review of internal models of the ECB, or which is also known in the industry as TRIM. And then we would like to close the topics of the day, and then we hope you, of course, have enjoyed us sharing with you all these developments. I think I'll hand over now to Luis to start with the proposed changes on IRB.
Thank you, Abdella. So regarding the proposed change to the IRB approach, well, the IRB approach has been and shall be facing relevant regulatory and supervisory developments in the next years. This is clear. And with them, significant challenges are posed to both banks and supervisors. On the one hand, EBA is actively working on the so-called future of the IRB, attempting to reduce the significant discrepancies that were identified in the risk estimates and capital requirements for credit risk, therefore enhancing the comparability of IRB models. In a nutshell, EBA shall be soon publishing new standards on the IRB assessment methodology, and indeed the final version of this RTS was published just last week, almost 1 year and a half after the publication for public consultation. New standards on the default definition, on the calibration and validation of risk parameters, PDs, LGDs, and conversion factors, on credit risk mitigation techniques, and also on transparency. This is Pillar 3. In fact, banks shall need to adjust their IRB frameworks, meaning implementing the needed changes, including the ones on default definition and parameter estimation processes by the end of 2020. On the other hand, through the BCBS 362 consultative paper, the Basel Committee recently consulted the market on changes to the IRB approach, both advanced or even foundation. And in particular, the proposed changes aim to reduce the complexity of the regulatory framework and improve comparability of the model outcomes. Again, the risk of the models losing the confidence of the market, and also to address the excessive variability in the capital requirements for credit risk. And for this purpose, the Basel Committee is proposing, for instance, the elimination of discretions in the use of the IRB approach for certain exposures. This topic shall be later on detailed by Stefan, but this is clearly one of the main proposed changes. Last but not least, the ECB decided to launch a multi-annual review exercise of approved internal models within the single supervisory mechanism. This is the SSM. And the objectives of this exercise is to recover the trust in IRB models for prudential purposes, and it is also applied to other models in use for market risk and counterparty credit risk, to increase the reliability, adequacy, and also comparability of the models and model outcomes, and also to define consistent standards and supervision guidelines now within the scope of the SSM and not, as it was before, within each national supervisory authority. The main outcomes of this exercise shall be the conduction of horizontal reviews of what are the current practices in place by banks, followed by target on-site reviews of specific models that are being flagged or shall be flagged by the ECB as the most risky models or the most critical for the final figures in terms of risk-weighted assets. So basically, if we go to next slide, on the EBA side, it should be noted as an overview that the CRR introduced, this is the capital requirement regulation, introduced a number of mandates for EBA to develop RTSs, regulatory technical standards, and also guidelines to ensure a more harmonized application of the IRB requirements. In fact, EBA plans are included in a discussion paper that is called The Future of the IRB Approach, which was firstly published in March 2015. Still this year, in February, the main conclusions of the feedback that was obtained from this discussion paper were also made public. It is clear that EBA aims to enhance the use of the IRB approach, because of its risk sensitivity. Indeed, the proposed change are intended to increase the harmonization of definitions as well as regulatory and supervised methods, so that at the end of the day, model outcomes can be indeed comparable. EBA also explicitly stated that capital requirements are not intended to be increased due to the revised documents. And in this regard, let's see what happens at the end. Finally, I would highlight that the BCBS and EBA, they are articulated in what concerns time schedule and implementation plan of the regulatory changes, so no overlaps are expected to occur. If you look to the second part of the slide, in terms of storyline, underlying EBA action is the fact that EBA believes that the solution for the lack of trust regarding the use of internal models for prudential purposes must be based on three strands of work. Regulatory review of the framework. For this purpose, EBA intends to publish a huge pipeline of RTSs and guidelines on internal models, majority of which in the credit risk side, to ensure supervisory consistency and a setup in the CRD4. EBA is responsible for running a yearly benchmarking exercise on model outcomes with potential impacts for those banks that are identified as having outlier models. And finally, through increased transparency. This is harmonized disclosure to enhance transparency on both internal models and outcomes. So now on slide 7, we see that there are 8 hot topics that are covered in the EBA discussion paper that really require clarification of the applicable requirements. Of course, that for the sake of time, I will not dive into all the details. I would only like to highlight the following. Default definition, and now following clock-side path. So default definition is clearly one of the key hot topics, namely what concerns the counting of days past due, the definition of technical defaults, and the inclusion of indications of unlikeness to pay. And please have in mind that historical data must probably shall need to be adjusted, and this can be very burdensome for banks, and in some cases not even feasible. The treatment of defaulted assets is another hot topic, namely the lack of clear rules for LGD models and of clarity between expected loss and accounting provisions under IFRS 9 impairments framework. On the scope of application of the IRB approach, flexibility is being requested by industry in terms of both the scope and the length of the rollout. On internal risk management, clearly that the independence of the validation function is in the spotlight of regulators and supervisors. Scope and granularity of credit risk mitigation is also in discussion. On risk parameter estimates, the margin of conservatism and the definition of long-run average economic cycle are two of the most controversial areas that are still being discussed. Regarding LDPs, low default portfolios, key questions such as which criteria to use to define LDP, only quantitative or also qualitative criteria should be used. Data pooling, indeed should be encouraged to overcome data scarcity, but which external databases are indeed fit for purposes? So these are some of the questions that are being raised, among which, for instance, the use of floors for LGD. Should they be temporary or a definitive solution to be put in place? Finally, there are other areas of discrepancy, which include, for instance, the application of floors and risk parameters, and even the treatment of sovereign exposures. And this can indeed be a really critical topic to have a final view on. As you can see, new rules over these hot topics may significantly impact risk-weighted assets or imply relevant organizational and strategic changes from banks. And in my opinion, this is clear, or can be clear consequences of new rules or new clarification regarding these topics. And now I hand over the word to Stefan.
Thank you, Luis. And now, having looked at the plans of the EBA to ensure a harmonized implementation of the IRB approach within Europe, we turn our view to the Basel Committee, which has a more global outlook and which does not, well, fasten some screws and turn some switches, but thinks about the scope of the IRB approach as a whole. And as we can see, there are three major proposals by the Basel Committee, and the first and probably the one with the largest impact is to limit the scope of portfolios for which internal credit risk models may be used. The focus, of course, once again, is the reduction of complexity and increasing comparability of risk-weighted assets. And one major step by the Basel Committee to achieve this goal is to limit the the portfolios for which IRB models can be used. Secondly, to provide parameters for the or floors for the model parameters for the PDs, LGDs, credit conversion factors that may be calculated by the banks, and thirdly, to have more stringent specifications for the parameter estimation. So not only PD and LGD, but also maturities used, credit risk mitigation, and so on. And we will look at all of these three steps in more detail in a minute. Before, just one more thing, BCBS 362 is the first consultation paper by the Basel Committee with regard to the IRB approach. Basel promised to finalize it until the end of 2016, which either means December 23rd or more probably first quarter of 2017. And there was also a quantitative impact study conducted at the beginning of this year, where IRB banks were asked to calculate the impact of BCBS 362, and we all expect another quantitative impact study to follow over the course of this year. But now let's turn to the three areas in more detail, and as you can see on this slide, the major topic is the BCBS's proposal to no longer allow the IRB approach for certain exposures, for certain portfolios, such as banks, large corporates with total assets of more than 50 billion euros, and equity instruments. And it is, of course, clear from the very beginning that this will have a major impact if those portfolios would have to be used, shifted to the standardized approach. Also, the advanced IRB, which allows banks the estimation of LGD and credit conversion factors, will no longer be allowed for corporates with revenues above 200 million euros, and also the possibility for specialized lending to estimate PDs and LGDs for specialized lending exposures will be prohibited. So banks will have to shift those portfolios also either to the standardized approach or to the so-called slotting criteria approach, and we will have a look in a minute at the impact that these changes will bring. What is also noteworthy is that BCBS 362 does not mention exposures to sovereigns, and this is the same that we've seen in the Basel Committee's consultation papers regarding the revised standardized approach for credit risk, as here also the whole topic of sovereign risk is not touched, but instead it is always said that there will be a separate consultation that deals exclusively with sovereign risk. Also, of course, our expectation very clearly is that a prohibition of the IRB approach for sovereign exposures will also be considered. Now, what does this mean? If you look at the lower part of the slide, you can see some sample calculations that we performed, where we compared risk weights according to the IRB approach and the standardized approach for credit risk. In the left-hand side of the slide, you can see the impact on large corporates, where we have a noticeable increase in risk weights. Average value is 2 to 3 times higher risk-weighted assets across nearly all rating grades. A bit of a different picture emerges if we look at institutions on the right-hand side of the slide, Here we also notice an increase in risk weights, but not so pronounced. But what we can see here for the first time, if you look at, for example, HSH Nordbank, which has a, well, not so excellent rating, which has a 65% risk weight under the IRB approach, but will only have a 50% risk weight under the standardized approach. So here we see a tendency that the probably more risky exposures may even profit from a move to the standardized approach. And this is even more pronounced if we look at the specialized lending exposures in the middle of the slide. Here you can see very clearly that the move from the IRB approach either to the slotting criteria approach or the standardized approach clearly implies that risk sensitivity will decrease. And you can see this very clearly when contrasting the ship financing and real estate financing in the middle part of the slide, where, for example, with regard to the ship financing, the massive 248% risk weight under the IRB approach will turn to a 100% risk weight under the standardized approach. And on the other hand, the real estate financing with a 54% risk weight under the IRB approach will more than double to 120% under the revised standardized approach. And this very clearly shows the drawback of no longer allowing risk-sensitive approaches and instead turning to the standardized approaches. Now, coming to the second area of revision, on the next slide, you can see the proposed use of floors for PD, LGD, and credit conversion factors for those portfolios where banks are still allowed to use the IRB approach. What is very evident from the first look at this table is that, for example, the PD floor will increase from 3 basis points to 5 or even 10 basis points, depending on the portfolio, on the type of exposure that we look at. And there are also floors for advanced IRB banks, for LGDs and credit conversion factors. And of course, this always means that whenever one of those floors kicks in, there will be an increase in capital requirements, and the Basel Committee is aware of the danger that this may pose, that the use of collateral is no longer as effective in reducing capital requirements as it is today, and therefore may encourage banks once again to turn to more risky activities. Now, the final area of revision on the next slide are the proposals for the amendment of risk parameter estimation, and here we find a lot of issues that were already touched by Luis when talking about the future of the IRB approach. And here the proposals are not only limited to PD, LGD and CCF, but also to maturity and credit risk mitigation. So, for example, a large issue is the use of through-the-cycle PD models, as well as the downturn add-on for the loss given default. We also have an increase in haircuts for collateral on the one hand side. On the other side, we no longer have minimum required collateralization level. So there is a lot of movement with regard to the LGD, and it will be very interesting to see what the effect of all these changes will be. Regarding the credit conversion factors, we have further restrictions on the portfolios for which own estimates of CCFs may be used, and for all those portfolios, banks must apply the credit conversion factors according to the standardized approach, which are calibrated in a more conservative way under the revised standardized approach for credit risk. We have some changes regarding the maturity date, where we now are forced to look at the legal maturity date. And finally, there is a number of changes with regard to credit risk mitigation. For example, the so-called double default approach will no longer be eligible. Other types of guarantees or credit derivatives will no longer be eligible, or only eligible under the advanced IRB approach. Internal estimations of haircuts are no longer allowed under the foundation IRB approach. and so on and so forth. So we expect to see also quite some changes with regard to the collateral accepted by banks or collateral policies under BCBS 362. And now that we have looked at the proposals of the regulators, we finally turn to the proposals of the supervisors. And here I hand over again to Luis, who will take a look at the targeted review of internal models.
Thank you, Stefan. So regarding TRIM, the target review on internal models, it clearly emerges as an answer of DCB to the lack of trust in the use of internal models for regulatory purposes. DCB has recently identified around 2,400 group of models. The great majority of them were inherited from the national supervisory authorities. This lack of trust has indeed resulted from high flexibility that is embedded in the IRB framework, grounded on the CRD and the CRR, to natural incentives of banks to benefit from regulatory arbitrage, and they're ensuring low capital requirement levels, and divergent supervisory practices and interpretations across Europe. And this is also one of the key reasons why, at the end of the day, we find significant differences in terms of the model outcomes. TRIM is meant to restore the credibility and adequacy of Pillar 1 internal models by ensuring compliance with regulatory requirements and harmonization of supervisory practices, by publishing supervisory guidelines and issuing remedy actions to indeed correct any kind of flaws that exist, by improving the future supervisory work on internal models. This is about ECB capacity building on following up all the models that are approved, and of course calculating adequately capital needs. For this purpose, the ECB shares the industry concerns of ensuring an integration of the future international regulatory developments from both EBA and the Basel Committee in order to accumulate upcoming changes and also to leverage on the IRB model stocktake in 2015. It's a question of avoiding new massive data collection about data that was already requested to the banks. Additionally, since the ECB cannot review all the models, this is not possible to do it at once, it plans to apply a target approach to very specific topics and models based on the supervisor knowledge of what is indeed material, and try also to integrate all TRIM-related activities in regular model validation. I mean, talking about SREP and all the SSM environment. In terms of scope and schedule, TRIM shall focus on credit market and counterparty credit risk internal models, so no operational risk models are included. This year, 2016, the emphasis shall be put on methodological harmonization, on the model governance framework review, including model validation policy, model use and data quality processes, and also model map and prioritization. So we are talking here about benchmarking of model outcomes. Properly answering to the data requests and properly preparing supervisory visits are at this stage really critical activities where banks should invest their time and resources. If you look to 2017 and then 18, they shall be dedicated to IT and data quality reviews, so on-site work in this regard, and of course on model-specific on-site reviews. So basically, the list of models that shall be selected by DCB, they shall demand the existence of on-site teams, model experts, from banks' perspective, but of course from DCB, and they shall do through review of the quality of those models. So banks should be prepared in terms of their own resources and logistics to accumulate the reception of the ECB teams. And this is it. I hope you have enjoyed the session. Clearly, we have covered the developments from EBA, from the Basel Committee, and now on the ECB.
Thank you, Luis. Thank you, Stefan. I think it was very clear and good overview of all the changes. I think in summary there are quite some expect significant changes, ongoing, but also the scrutiny by the supervisor, ECB, through the TRIM. And I think especially the proposal from the Basel Committee will require some good analysis as to understanding what the effects are, because the effects may well be quite significant, especially the scope limitation. And I think on the EBA side and all the developments and expected changes, of course, is also relevant to take into account at some point the materiality of those extensions and changes, and eventually any approval or notification requirement as according to the delegate regulation of 2014. I think what I would like to share in terms of, to close this session, we've been, this was our 5th episode of the Basel IV channel. We are now taking basically a summer break. The session of this, of today was basically meant to be the August session, but because of holidays of many of you, we planned this today. We're taking a holiday break and we'll continue our Basel IV channel after holiday in September. Another thing I would like to share with you is, as many of you know, we are hosting the regulatory roadshow. Basically, we are organizing at different premises of PwC around Europe, organizing, say, a 3-hour, 4 hours presentation about all the changes that also we are, of course, covering in this about the IV channel, but we're also taking it into more detail. I think we have had quite some roadshows already. Most of the, I think all the roadshows in Germany have taken place. I think in Germany we had around even 800 participants, and we had also some other countries. And after the summer, in September, October, we will continue with many other countries, including Spain, Portugal, the Netherlands, Ireland, France, Luxembourg, but many other countries. And I would like definitely to invite you to those roadshows. Please contact your local Basel IV contact, and of course, if you have difficulties in doing that, please contact anyone of us, and we would be very happy to have you at one of those roadshows. I think this was it for today. We again would like to thank you, and we hope to meet you either virtually or physically after holidays again. Thank you, and have a very good weekend and a good holiday.